Hi candidate, welcome to another session of Manifested Online Classes. So in this particular session, I want us to look on an illustration question on analysis of financial statement. And the question I want us to go through is the question which was tested in the sitting of August of 2022, specifically question number 5B. So the question reads, Dragon Limited is a public entity which has grown in recent years by acquiring established business entities. The directors of Dragon Limited have identified two potential entities targeted for a takeover. The directors believe that shareholders of the two target company would be recipient to a takeover. As a prerequisite to the takeover decision, the directors have tasked a firm of consultants to carry out cross-sectional analysis of the financial statement of the potential target companies which operate in the same industry sector. The financial statements of two entities as at 30th April 2022 are shown below. We have the statement of profit or loss for the year which ended 30th of April 2022 for two companies, Ebo Limited and Cedar Limited. We have revenue, cost of sales, gross profit, distribution cost, admin expenses, operating profit, finance cost, profit before tax, income tax expense, and then we have the profit for the year. We also have the statement of financial position as at 30th of April 2022 for Ebo and Cedar Limited. We have the non-current assets which include property, owned plant, right of use asset. At the current asset, we have inventory, trade receivables, bank total assets, and then we have equity, which comprises of ordinary share capital, evaluation reserve, retained earnings, and then we have the total equity. At the non-current liabilities, we have the lease liability, 10% loan notes, and then we have current liabilities, which comprises of trade payables, lease liability, current tax, and then we have the total equity and liabilities. What is required in Roman 1 of that question is common size statement of profit or loss for the two entities for the year which ended 30th April 2022. Roman 2 common size statement of financial position as at 30th April 2022. And finally, we are required to advise the directors of Dragon Limited on the best company for the takeover. So let's start with the Roman 1 of that particular question, whereby the examiner was requiring we prepare common size statement of profit or loss, statement of profit or loss for the two entities, which is for the year which ended 30th of April 2022. Remember, when talk about the common size, a statement of profit or loss, this is prepared by expressing all items in the income statement or the statement of profit or loss as a percentage of total asset. So not the total asset, but rather the revenue or the total what? Revenue. We are going to express all items as a percentage of the revenue. And take into account we have two companies. We have two companies. We also need to have two columns here. The first column will be for the company which is called Ebo Limited, and the other one will be for the company which is called Cedar. So what we do, we express all those items in the income statement as a percentage of revenue. So revenue as a percentage of itself is always 100%. This one is 100% because what we do, we take the revenue, for example, for Ebo, 87,500, then the denominator here will be the revenue. So 87,500 times what? Times 100, times 100. So that is always 100%. Then we have the cost of sales. So to express the cost of sales as a percentage of revenue, we take the cost of sales 66,500 divided that with the revenue for that company which is Ebo, 87,500 times 100. That is for the first company. For the other company which is Cedar, we are going to do the same. Take its cost of sales 114,800, divide that with the revenue for Cedar Limited times what? times 100. So let's compute this. We see what we are going to get here. We see what we're going to have. So we have 66,500 divided by 87,500 times 100. That will give us 76%. 76%. What about the other company? Okay, so I think first of all we can deal with the ABLE, whereby we are going to express all items in the income statement of ABLE Limited as a percentage of what? Of revenue. So let's go to the gross profit. Gross profit. So the gross profit in this case is 21,000 divided by revenue 87,500 times 100. This will give us 24%. What about the other item, which is the distribution cost? Distribution costs. So the distribution cost is a figure of what? Is a figure of 1495 divided by 87,500 times 100%. That will give us 1.78%. Then we have the administrative expenses. The administrative expenses, which is 2880 divided by revenue 87,500 times 100, which will give us 3.29%. Then we have the operating profit. Operating profit. And I hope you can see what I'm doing here. We are expressing everything as a percentage of revenue. You don't have to underline anything. You don't have to put anything. You don't have to show anything as a negative. You just show, you express all those items as a percentage of revenue, as a percentage of the company's revenue. So we have the operating profit, which would be 1625 divided by 87,500 times 100. So that will give us 19%. Then below that we have the finance cost. Finance cost. The finance cost in our case is 875 divided by 87,500 times 100, which will give us 1%. This is 1%. Then below that we have the profit before tax, which is a figure of 15,750 divided by 87,500 times 100%. Times 100%, which will give us, okay, let's take that again. We have what? We have 15,750 divided by 87,500 times 100, which will give us 18%. Then we have the income tax. So for the income tax is 3150 divided by 87,500 times 100, which will give us 3.6. And finally we have the profit for the year. The profit for the year, 12,600 divided by 87,500 times 100. That will give us 14.4%. 0.4%. So we need to repeat the same process for the other company, that is CEDA. We express everything as a percentage of the revenue for CEDA. So we go to the cost of sales here, which is 114,800 divided that with revenue, which is 140 times 100. That will give us 82%. 82%. What about the gross profit? 25,200 divided by 140 times 100. This will give us 18%. Then we have the distribution, which is 2710 divided by 140 times 100, so which will give us 1.9%. Then below that we have the administrative expenses 5340 divided by 140,000 times 100, which will give us 3.81%. Then from there we have the profit, the operating profit 17,150 divided by 140,000 times 100, 12.25%. And then below that we have the finance costs 3150 divided by 140,000 times 100, which will give us 2.25%. Then we have the profit before tax 14,000 divided by 140,000 times 100, which will give us 10%. Then we have the income tax 3,500 divided by 140,000 times 100, which will give us 2.5%. And finally we have the profit for the year 10,500 divided by 140,000, which is 7.5. So that is what we refer as the common size statement of profit or loss. It is also important to note that from this common size statement of profit or loss, there are a number of ratios which you have already computed here and which you can use in terms of evaluating which company is performing better than the other. So the first ratio which we have computed is what we have here, this one. Because in computing this, what we have done, we have taken the gross profit all over revenue times 100, and therefore this is a gross profit margin. So you can use that to compare the profitability of two companies, and going with the gross profit margin, we can say this company is profitable than Able is profitable than Cedar. We also have this other ratio here, which we have computed by taking the operating profit or the profit before interest and tax all over revenue times 100. So this is what we refer as operating profit margin. So equally, you can see going with that ratio, profitability ratio, we can see this company is more profitable than Cedar. And also we have this other other ratio here, where we have taken profit after tax all over revenue times 100. So this is what we refer as a net profit margin. And equally going with that, we can also see that this company here, that is Able, is more profitable than what? Cedar. In fact, we can make that particular conclusion here, that Able Limited is more profitable than what? Than Cedar. Limited. Remember, this particular information will help us in terms of advising the management of the management of this company, which is Dragon Limited, on which company to acquire. Remember, we are told that Dragon Limited is targeting to acquire either Able or Cedar. So if in this case we are advising the management or we are advising the management on which company to acquire based on their profitability, automatically we are going to advise them to acquire which company? This company that is Able, because you can see as per these three profitability ratios, this company is more profitable than what? Than Cedar. So let's move to Roman 2 of that particular question. And Roman 2, what the examiner was requiring is the common size statement of financial position. Common size statement of financial position, and this one is basically prepared by expressing all items in the statement of financial position as a percentage of the total asset. Equally, you have to remember that the common size is also known as the vertical analysis. The vertical analysis statement of financial position. Statement of financial position. So here what we need to do is to express all items here as a percentage of total asset. We equally need to have two columns. We have Able Limited, and then we have Cedar Limited. We are going to express all items as a percentage of a total asset, as a percentage of total assets. So we start with the non-current assets. We have property. Then we have owned property or owned plant. We have right of use asset, right of use assets, and then we have the current assets. So for the current asset, we have inventory, we have trade receivables, then we have bank, and then total assets. Total asset. So basically, total asset, because we have to express everything here as a percentage of total asset. Once we express total asset as a percentage of itself, that automatically give us 100 what? 100%. 100%. 100%. So we're going to compute all these particular items as a percentage of total asset, and then below that we have equity. Equity, we have ordinary share capital. We have retained. Okay, before that we have revaluation surplus. Revaluation surplus. We have retained earnings. Retained earnings, and then we have the total equity. Okay, so we can just ignore that, and then we have non-current liabilities, where we have the lease liability, and then we have 10% loan notes, 10% loan notes, and then from there we have current liabilities. We have current liabilities. For current liabilities, we have three. We have trade payables. We have lease liability, and then finally we have current tax, and then we have the total equity and liabilities. Total equity and liabilities, and equally here, total equity and liabilities, this is the same with the total asset, and therefore once we express this as a percentage of total asset, automatically it will give us what? It will give us 100%. So therefore what we need to do, we need to express all these items in the statement of financial position as a percentage of total asset. So let's start with the property, and we start by doing that for the first company, which is Able. So we have 9,800 divided that with the total asset. Total asset as given is 33,600 times 100, which will give us 29.2%. And then for the other company here, okay, for the other item we have 7,000 divided by 33,600, which will give us 20.8. This company was not having any right of use asset. What about current asset? We start with the inventory, 5,600 divided by 33,600, which will give us 16.7%. Receivables, we have 7350 divided by 33,600, which will give us 21.9%. And then we have the last item, which is not the last item, but the other item, which is 3850 divided by 33,600, which is 11.5. 11.5. So we need to do the same to the other items of equity and liabilities. Let's start with the ordinary share capital, 3,500 divided by 33,600, which will give us 10.4%. 0.4%, and then we have 1750, which is the revaluation surplus divided by 33,600, which will give us 5.2. Remember here we are expressing everything as a percentage of total asset. What about the retained earnings? 5,600 divided by 33,600, which will give us 16.7%. What about the risk liability? This company was not having a risk liability. The company only had the 10% loan notes, which is 15,750 divided by 33,600, which will give us 46.9. Then from there we have current liabilities. So we have trade payables 4375 divided by 33,600, which will give us 13.0%. No risk liability. And finally we have tax 2625 divided by 33,600, which will give us 7.8%. So basically what we have done here, we have expressed all items as a percentage of total asset. We need to repeat the same exercise, the same process for the other company, which is CEDA. We compute everything as a percentage of total asset. Let's start with the property, which is 10,500 divided that with the total asset 66,500. This will give us 15.9%. The owned plant 8050 divided by 66,500, which is 12.1%. And then we have the right of use asset 17,500 divided by 66,500, which is 26.3%. We go to current asset. We start with the inventory 11,900 divided by 66,500, which will give us 17.9. Then from there we have 17, the other item of receivable 17,850 divided by 66,500, which is 26.8%. Then we have the last item, which is bank 700 divided by 66,500, which is 1.1%. 1.1. Okay, so we go to the items of equity. We have 7,000 divided by 66,500, which will give us 10.5%. Then we have revaluation surplus 150 divided by 66,500, which will give us 4.7%. Retained earnings, we have 9450 divided by 66,500, which will give us 14.2%. What about the risk liability? 14,700 divided by 66,500, which is 22.1%. And then the 10% loan notes 17,500 divided by 66,500, which will give us 26.3%. We go to the current liabilities. We have trade payables 7350 divided by 66,500, which will give us 11.1. We have 2450 divided by 66,500, which will give us 3.7%. And then finally we have tax 49 divided by 66,500, which will give us 7.4%. 0.4%. Yes. So basically that is it. That what was required there. We have been able to express all items as a percentage of what? The total asset, as a percentage of total asset. And basically by doing all this, expressing these items as a percentage of total assets, basically by doing that, you get how many marks? You get 5 marks. 5 marks. Marks. And equally, for the first Roman 1 of this question, equally the marks which were located here were 5 marks. Were 5 what? 5 marks. And then from there we need to answer the last part of that question. The last part of that question. So we are told to advise the directors of Dragon Limited on the best company to acquire. Advice on best company to acquire. So between these two companies, that is Able and Cedar, which company should be acquired? Which company should be acquired? So for you to be able to, or for us to be able to give this particular advice, we base it on 2 aspects. One is the financial performance. And I think from the analysis which we did here, we said that the first company here, that is Able, this company is performing well based on these 3 ratios which we identified there. So based on the performance, the best company to acquire is what? Cedar. Number 2, you also have now to look on the financial stability of the company. So when checking on the financial stability of the company, you look on the extent to which the company is financed by the debt capital or by the borrowed capital. So therefore what you do, you come here and you check which company is financed by huge amount of debt capital. And basically in this case, when talk about the debt capital, I think we are talking of, I think just one here. This is the main form of debt capital, the 10% loan notes. Here we can be able to see that this company is 46.9 and this company is 26 point what? 0.3. Point what? 0.3. So therefore in this case equally we can be able to recommend that this company or the directors of Dragon to acquire which company? To acquire Able. So therefore you can say advice on the best company to acquire, we can say I will advise directors of Dragon Limited to acquire as Able Limited, since it is more profitable, it is more profitable than Cedar Limited. It is more profitable than what? Cedar Limited. Basically by giving that particular advice, you get how many marks? You get 2 marks. You get 2 marks. Yes. So basically that is it. That what was required as far as that particular question is concerned. And that is the only question which has been tested in this particular past papers for FRA regarding what if is the common size analysis. Equally, that brings us now to the end of that particular topic. And the topic was analysis of financial statement.